Hi there. I'm Howard Marks. I'm the co-chairman and co-founder of Oak Tree Capital Management, which is an alternative management firm dedicated primarily to credit products. I've been in the investment management business since 1969, and I'm pleased to be on this call with Joel Greenblatt. Joel is one of the world's leading value investors, and we'll talk later about what that means. I've known Joel for about 30 years and have greatly enjoyed working with him. It's a real pleasure to be on with him today.
Well, Howard, thank you very much. I'm one of your biggest fans. I know you have a lot, but I'm one of the biggest. And it's a real pleasure to be here today. I am the co-CIO at Gotham Asset Management, founded Gotham Capital in 1985, started in the business 1981. So seen a lot. And looking forward to talking to Howard about it. Well, Howard, I guess the first question out of the gate, a lot of people would like to know, are we in a bubble of some sort?
We are definitely in a time of optimism. And I think that optimism is largely what I call man-made, relating or stemming primarily from the actions of the Fed and the Treasury to counter the economic weakness of 2020. The economies of the world and the markets of the world were cascading down in March of 2020 when the Fed and Treasury came out with programs in mid-month and the Fed strengthens its program on March 23rd. At that point, the market was down about a third, its fastest decline in modern era, and however, the programs worked and produced a rebound. The S&P ended up the year 18%, and the tech stocks were up much more than that. The interest rate cut to zero had a profound effect, and it produced a resurrection of risk-bearing. FOMO, fear of missing out, took over from fear of losing money, and it really led to a very strong demand for security. So that's worrisome. The PE ratio on the S&P is high relative to history. We see risky behavior ranging from the rapid acceptance of financial innovations such as SPACs, which have taken over the consciousness of many investors, to the ease of doing IPOs, especially for companies that are unprofitable, and the very great performance of those stocks on their first day. And then we have phenomena like GameStop and so forth, which and we have the heavy involvement of retail buying, margin buying, and option buying. So a lot of these taken together could be signs of a bubble. But I think that most asset valuations are reasonable relative to the level of interest rates. The lower interest rates are, the higher the PE is that's warranted. Valuations of all assets are higher when interest rates are lower, which means that the demanded rates of return on all assets are lower. So I think that the PE ratios are justified, and most assets are at equilibrium relative to each other. They just all are priced to produce below history returns. So I think bubble connotes unreasonably optimistic psychology and a belief that there's no price too high for the bubble asset. And I don't think that those are going on today. I just think that, as I said, all prices are up because all demanded returns are down, prospective returns are low across the board, and that means that the continuation of markets at these levels is contingent on the continuation of low interest rates. That's the primary conclusion I've drawn. What about you, Joel?
Well, I can't disagree with anything you said. I actually agree with it. I would just maybe add a little bit. The major market averages, I agree with you. They're high but reasonable with expected returns, perhaps below normal, what we've come to expect. Last 50 years, the S&P has been up over 10% a year. So not sure at these prices that would continue. I'm not certain it won't. There are elements of froth. It's a market of, if we're talking about the stock market, a market of stocks, not a stock market. And so if we did some work and there are over 300 companies that lost money in 2019. And so that's pre-pandemic, not affected by pandemic. And they now have a market cap over $1 billion, those 300 names that lost money in 2019. And in 2020, they were up over 100% on average. The median stock was up over 70%. So these are just looking at the batch of companies with market cap over $1 billion that lost money. So that's not usual. While I believe that Amazon, Google, Microsoft, Apple are some of the greatest businesses that we've ever seen, and perhaps are actually priced reasonably given the nature and how great the businesses are and low interest rates and all that stuff. I do not believe there will be hundreds of other Amazons, Googles, Microsofts out there. Many companies are priced as if they will be. I think that's an element of froth. But if you are in an index which is heavily market cap weighted, for the biggest companies, that may not affect you that much because these are smaller companies where the froth is. And so some combination of look out in certain areas of the market, and in others, you could be okay.
Right. Just two responses. Number one, I certainly agree with your observation. One of the features of a bubble is that people conclude that every member of the subject asset class will be a success. In 1999, everybody said the internet will change the world, so you have to get involved in e-commerce. And the internet did change the world, and all those e-commerce companies, well, a few of them are household names today, but many, many are gone. And the other thing is that in my most recent memo, I did mention the fact that never before has it been more acceptable to be unprofitable. When we started, the fact that a company lost money would pretty much put it off limits. And today, it's not a problem for anybody, and people are lined up to invest in companies that are unprofitable.
Well, just because I have to, I've given a lot of thought to that concept of, is losing money always bad? And of course, it's not. But I do think accounting, traditional accounting hasn't really kept up with what's going on, because if you're taking a look at the lifetime value of a customer, and you're going to get a stream of earnings from that customer over a period of years, and let's say your average customer is going to last 8 years, and you make $1 a year from that customer, let's say you're a software program, but it costs you $2 the first year to get that customer. So the accounting would say, well, I spent $2, I got $1, I lost $1, but the lifetime value is $8, and that's what, from an economic standpoint, the business is taking a look at. There's no contract that says you have to stay 8 years, but in general, if you have a sticky software program or something like that, it's a reasonable guess and it's a reasonable business decision. So is that spending, should it be capitalized in some way? Should, the advertising spending and, when Amazon, creates Prime Video and spends a lot of money, or Netflix spends a lot of money producing videos that last a long time, and the customers are signed up from month to month or year to year, it's very hard to understand if that's CapEx, or in what way should that kind of spending be expensed from an accounting standpoint. I don't have an answer to that question. As a investor, I just have to make reasonable assumptions about that. I'm not saying we should really change the accounting standards, but the accounting standards, when you're showing losses, and also maybe it's good because you get to deduct those expenses right away and you don't have to pay taxes, and there's a lot of reasons about that. So there's an interesting model where it's not really about capital, building a plant or stocking inventory or something like that, that's creating value that, traditional accounting metrics have always recorded as capital spending. Now there's a lot of way to build a business fast without a lot of capital, but you do have to invest to get customers, and these are potentially long-term sticky customers. And so just interesting questions, and saying they lose money or even losing cash flow now, obviously that's the beginning of the discussion, but not the end. And so that's changed in my mind.
Well, that leads me to the old saying that this time is different. And Sir John Templeton stated several decades ago that people tend to get into trouble when they start saying this time is different. What do they mean is that the constraints of history don't matter. The normal business cycle and the normal performance of business in the past doesn't matter, and the valuations standards in the past don't matter. And as I say, when people say those things, they get into trouble. On the other hand, he allowed, back in 1985, I think it was, that 20% of the time it really is different. And that was then. And the world was a pretty static place then. And I would say right now, it's probably really different 40% of the time or 60% of the time. And the example you gave was one. So one of the things that's different this time is interest rates. Back in 40 years ago, in 81, I had a loan outstanding from a bank, and I still have the ticket on my wall. It says the rate on your loan is now 22.75%. Today I can borrow at 2.25%. Let's talk about the changes that has produced. I mentioned the change on the effect on valuation, the world has been flirting with negative interest rates. Do you think we'll have negative interest rates, and what would be the impact of that? And lastly, when the demanded return on something is negative, its value is infinite. How do you factor the difference in interest rates and the outlook?
Well, that's obviously a question that I don't have a great answer to. I would just say that what I'm trying to do as an investor is normalize interest rates over a long period of time. In other words, buying a equity stake in a business is a long-term investment, and I'm going to get a stream of earnings over a long period of time. So depending on how I finance that, but if it's my equity capital, I have to take into account the prospects of what the world will look like, 3, 5, 10 years from now, and so I want to normalize interest rates, not just look at current interest rates. If I'm not borrowing money at 30 years at a low rate and then investing in stocks, that would be different because I'm locked in. But for me, I try to normalize rates, and what doesn't change is sort of thinking about Ben Graham and margin of safety and say, well, I pick a really high risk-free rate, and I written many times and wrote. I mentioned 6% risk-free rate, and that was a book I wrote in 2005. So things have changed a little bit. But my standards haven't changed, because if I don't expect to make a risk-adjusted return above 6%, then I'm probably not going to invest in an equity. So I really haven't changed that. I'm not trying to say, well, risk-free rate is 2%, so I can accept a 5% expected return on my equity investment. Both businesses go up and down as far as their prospects are concerned. Rates aren't stable over time, and probably I'm not expecting normalized rates to stay this low. That doesn't mean I'm right. It means, how do I attack this? I'm picking conservative assumptions. And if I still want to buy it, then that's the way I'm trying to attack this area of low interest rates. I don't know the answer. I don't know actually even how to think about interest rates when it's not clear they're fairly representative of what's going on in the world. Are they being manufactured either on the short end by the Fed, or the long end by the purchase of long-dated government bonds to push those rates down by the government? It's really hard to get my bearings on what is the actual price of money, which is a very dangerous thing to be toying with. So what's wonderful about having a grounding in, the precepts of value investing along the lines of Benjamin Graham and Warren Buffett is that, well, I'll just throw in a big margin of safety in the I don't know category. And if rates were to move up and this would make it a bad investment, I probably wouldn't want to own it. Of course, it's a world of alternatives. You have to put your money somewhere. But I would say one of your choices, as Seth Klarman and many others have said, is not only what's in front of you today, but what might be in front of you 6 months from now, 2 years from now, and you want to keep your powder dry for that. And so your list of choices is not just what's in front of you today. It's important to keep that in mind. So if rates stay this low, yeah, you can pay high prices for lots of things. My assumption is they won't. And if I still want to buy it, that gives me some comfort and margin of safety. I don't know what you think of this, Howard, but I'd love to hear.
Well, one of the reasons you and I have great conversations is because we think a lot alike. I've been thinking for a long time, since '08 actually, that interest rates have not been naturally occurring. Presumably, all of us as investors are capitalists, and we believe that the capitalist system, the free market system, is the best allocator of resources. But when interest rates are administered as opposed to naturally occurring, then you can't have great faith that that capital allocation will be optimal. Another question that you rightly give credence to, you talk about normalizing interest rates, but what's normal? I mean, is 22 normal? Is 2 normal? Is 6 normal? When I started managing money, when I switched from equity research to high yield bonds in 1978, the short-term rate was, the T-bills were 9%. So I would say that your 6 is not high enough. But of course, thinking about 6 or 9 today, when they pay a fraction of a percent, it seems crazy. So we know we want to normalize, we just don't know what normal is. The other thing I would say is that, well, I think the one thing that you and I would agree on is that the big mistake today would be to make optimistic assumptions for growth and profitability and then apply today's low discount rate. That would be a disaster. We don't want to do the opposite either. We don't want to make draconian assumptions and apply 9% or 6%, because that would be nutty. But I think that we can all agree that interest rates can go up, but not down. When the Fed funds rate is 0, and the Fed says repeatedly that they're not going to go negative, I think we can agree that the 40-year tailwind of declining interest rates that has lifted the price of all assets is at an end.
I appreciate that, Howard. So just a little bit on this topic. Do you have any thoughts on the amount of fiscal and monetary stimulus that we've seen? Do you think it's too much? Do you think it's going to end well or badly? Do you think it's going to end?
Well, that's the question. Herb Stein, the great economist, once said that if something cannot go on forever, it will stop. And I think we can't argue with that. The question is, can the Fed keep it up forever? Can the Fed, which seems to have adopted the responsibility to preclude recessions and difficult periods, can they keep it up forever? Now, last year, I think the Fed increased its balance sheet by 2.7 trillion, and the Treasury spent 4 trillion that it didn't have to fight the pandemic. We worry about the long-term consequences, the effect on inflation, the value of the dollar, the creditworthiness of the dollar, the acceptability of the dollar in the world. You can't run trillion-dollar deficits every year if you can't print an unlimited amount of money. Is the answer. Now, modern monetary theory says that for a country that is in control of its currency, deficits and debts don't matter. But the question is, will we remain in control of our currency, able to print unlimited amounts? Will we remain the world's reserve currency forever? I wouldn't think so. Keynes, everybody talks, kind of a synonym for running deficits is the word Keynesian. Keynesians believe in deficits. Prior to Keynes, 100 years ago, deficits were taboo. So 100 years ago, before Keynes, deficits were taboo. Keynes said you should run a deficit in a time of weakness. to create jobs and buoy the economy. But then in times of prosperity, you should run surpluses and pay it back. And everybody's fine with the first part, and nobody cares about the last part anymore. And I think that's questionable. And I think that you can't dump $7 trillion into the economy without any impact. And by the way, it looks like the Congressional Budget Office, I believe, is talking about $3 trillion deficits this year and next year also. And the Fed is still buying bonds at $120 billion a month, which is another $1.5 trillion. So can these things go on, forget forever? Can they go on for 3 years or 5 years without impact? And it's hard to believe that there won't be any ramifications. On the other hand, and the great thing about the investment business is that there's always another hand. I believe that the world was headed for global depression if the Fed and Treasury and the world's other central banks hadn't done what they did. And so even though I believe there's a likelihood that these things will have negative ramifications, I think they had to do it anyway. And you can't let the possibility of negative ramifications stop you from doing what you must do.
I would agree with that, wholeheartedly, especially with the pandemic. I mean, if you tell people to stay home and don't go to work and close businesses and everything else, that's the Keynesian answer would be, of course, no, we have to help now. And I think that's really a no-brainer, and that we have to do it. What are the repercussions of doing it? I think they're less severe than other types of spending. So in other words, if we're filling a big hole here and maybe we overfill it, but we spend 5 trillion or 10 trillion it's like we're in a war. We have to fight it for whatever reason. Maybe it's survival, whatever. The good thing about a war is that generally they end. Same thing with the pandemic. If these were entitlement programs that were going to continue forever, that's one thing. This is a one-time 5 or 10 trillion that we have to plug a hole where the economy falls apart and people aren't eating and people don't have money. A, we don't have a choice, but B, what are the repercussions? Well, if we were actually borrowing the money for 30 years at 1 point, whatever it is, 5%, that would add about 3% a year to our annual budget. And I think we can handle that, the carry on that. Unfortunately, I'm no expert on this, but I think our average maturity of our government debt is more like 5 or 6 years. We're not borrowing at 30 years as we should to plug this hole. We're borrowing much shorter. And if rates go up, of course, we're going to have a problem. And then you have the whole other problem is, do we dig ourselves such a big deficit hole that the carry on that debt, we can't let rates go up, assuming we have control of them, because we can't, they'll take up too much of our budget. So I'm really confounded as to, if we were to go borrow that money in 30 years, this 10 trillion or 5 trillion or whatever we got to spend now to get through this tough period, and it's a one-time spend, and we literally were borrowing at 30 years, I don't have a huge problem with it, because the annual carry is not a big chunk of our budget. It might add up to another 3%. But we're actually not doing that. We're spending the money and we're borrowing at much shorter duration when we have the chance to borrow at short rates, just to save a little money now. And I think that's not so smart. So I'm weighing both sides, and I have two hands like you do, Howard, and I'm not sure how that one plays out. But I would say we're not being very smart in the way we're financing this spending now. If it doesn't turn into entitlements and we're just used to spending money and not worrying about deficits, it'll turn out badly. If we're really trying to plug a hole, I'm for that, but finance smartly.
I think the yield curve always presents a trap, because the upward sloping yield curve presents low rates at the short end and induces borrowers to borrow short and not tie up low rates. And the higher rates at the long end induce buyers to buy the long maturities, which, when rates are low and unlikely to go lower, but could go higher, buying the long one is a trap. I think probably the easiest thing of many that you and I would agree on is that the big mistakes today would be buying long bonds and failing to sell long bonds. But I think we'll see some 30s, just not enough. And if it was me, I'd try some 50s and 100s. You know, Argentina borrowed money. Was it 3 years ago? 17, maybe 18. They borrowed money for 100 years. If Argentina can borrow for 100, why can't we?
I'm with you. I don't know why they're giving away free money out 30 or 40 or 50 years, but if they are, we should take it. And that'll solve a lot of problems. And we're not. And so that's the scary part.
What about inflation? I think that inflation is the greatest concern. Inflation would be the greatest reason for rates to go up, so that securities would have positive real returns. Are you concerned about inflation? And if so, do you do anything about it?
You know, it's bottom line, it's a complex adaptive system. I'm not sure if inflation goes up that the Fed can't still keep rates low and then go buy long bonds themselves, print money and buy long bonds, keep those rates. So I don't even know if that relationship between inflation and interest rates can't be played with. Obviously, I would be worried about inflation. If you print, I always learned you print a lot of money, you make a lot of money, then you know that will lead to inflation eventually. I still believe that. I don't know when that tipping point happens. I think the Fed is probably looking at the same thing. Usually the problem with that is it's a tipping point. It's not like a gradual thing like, oh, we see a little inflation, it happens. Sometimes these things end badly when everyone realizes that we've gotten to a bad place. And so that's what I would worry. So, and I actually think that's the way it would happen, that if we do hit that tipping point, the bad news about inflation happens quickly. And I would be wondering what happens to asset values, whether real estate and the stock market, which is built on low rates, what happens there? Can they still manufacture low rates if inflation takes off? And then the question is, how do you measure inflation? You know, when you're looking at real estate values and stock prices, is that part of inflation? And, you know, is there asset inflation that's not being put into the headline inflation rate? And what happens there? And so I would just say the whole thing boils down to be aware that this can happen, build in a large margin of safety of what you do. And that's why I use very high discount rates, very high normalized rates, maybe higher than seem reasonable at this point. But I need an absolute return. And I'm setting that bar high because I see these risks. I don't know which one's going to kick in when. As a long-term investor, I just want to say, you know, if this were to happen, do I still want to own this asset long-term? Anything we own can fall 30, 40% because in the short term. But what I'm talking about is real loss of money over a longer period of time. And if I held these good businesses, how will I come out at the end? Do I want to own that coupon on that business that's going to grow, that's going to be able to raise its profits over time to keep up with inflation? You know, I think that's the best defense, actually. If you have a business with pricing power that can raise that coupon, you know, their earnings coupon along with inflation, I can't think of a better way to protect against that. So that's sort of my outlook. Doesn't mean it'll be a great return. It'll mean it'll be better than my other choices.
You know, Joel, you talk about tangible value, dependable cash flows, and discounting them at an adequate rate. And I think that leads to the top of the value investing. And as I said at the introduction, you're known as a terrific value investor. I practice value investing myself. And yet I wrote a memo recently, stemming primarily from conversations with my son, who is a professional, I think you would say, growth investor. He may argue with the term or with the distinction. questioning the distinction and questioning the value investors' preference for profitability, tangible assets, all the things that many of the future tech leaders don't have. So how do you feel? What was your reaction when you read that memo? Maybe I should ask that.
Well, I love that memo, particularly because I have a 30-year-old son that's been investing for about 10 years. He's, maybe passed me by in some respects, with a fresh look on things. I tried to give him a good basis on principled basis of investing. But of course, investing is more art than science, and people bring to it there's different ways to make money. And, some of my son's biggest positions are in Amazon, Google, Microsoft, those type of businesses, which I agree with him, but I would say he's the one who dragged me along. And so much like your wonderful memo, I think I've been, the student has become the teacher in some ways for me. Just looking at things with fresh eyes is so helpful. And understanding the principles, and the interesting thing, I think, and made me think a lot. I think some of these businesses, and you started off the conversation is this time different? And of course, back when we remember the Nifty 50 and, it involved IBM and Polaroid, they looked like the inevitable businesses that'll grow forever and everything else. And of course, they haven't and didn't, and that's been history. Has the availability of the internet and the ability to put together worldwide franchises that are very tough to beat. If I'm thinking of AWS or, Microsoft's back office business and so many networked type, I guess, moats that companies have put together. I actually do think that some of these, the top 5 or 6 businesses do have some of the best businesses of all time. And am I anchored? It used to be, it's at 30 times earnings, I'm not looking at it. Forget about losing money. But even, 30 times earnings, well, you're going to have to that's assuming a lot of good stuff. But if you actually run through the numbers, and I like to have numbers anyway, even though there's, concepts that, I'm not a concept investor. If you can't take that concept and put numbers on it, or at least put conservative numbers on it, or optimistic numbers and still arrive at your value, it's problematic. But if you take a business like Microsoft, if you take a business like Amazon or Google and actually put a reasonable growth rate on for 5 years, and then look at where you are in 5 years, is 30 or 40 times earnings. And most of those businesses are not trading at much of a premium to the S&P in general. It's also a world of alternatives. And so you really come out that they're not astronomically priced. They're in many cases reasonably priced. Of course, you're making optimistic assumptions about the next 5 years, but if you can do that and then put even market multiples or assessed market multiples at that time, even a curmudgeon, I guess I'm old enough to say I'm a curmudgeon at this point with regard to these things, can really get to some of these values and actually think that you can get a nice return from here on some of these businesses, especially relative to the other alternatives, and also with a certainty that I haven't seen. So it's a combination of, it's putting all those concepts. I never really did the discounted cash flow. You move one number up, it grows 1% faster, or you add 1% more to your discount rate, you get, it's worth double or it's worth half. You just have to make little tweaks to those kind of things. So that's not really what I've used, but I have used it as a reality check. I'll make the most optimistic assumptions. I will discount back at the lowest rate I can think of, risk-free rate. And can I justify this price? And if I can't, I'm just not going to play. It doesn't make me right, but I can't know everything. I'm looking at the things that I can understand. And I think what I would say, similar to the discussions that you wrote in your memo about having with your son, were really eye-opening for me, because it was more like I was dismissing these things like beyond the pale. They're very expensive. I don't based on metrics that I'm used to using. But if you actually run the numbers and it makes sense, and your numbers don't have to be so fantastical, he made me do that. And so when I was smiling when I was reading your memo, because I've had very similar discussions, and it's nice to get fresh eyes on the world. You come from where you come. I think I forgot the expression, but the world moves forward. The world of economics moves forward with every dead economist. And I kind of feel like investors that way. And I'm so grateful. I mean, one of the reasons I taught for over 2 decades, I learned more from teaching than I did than my students did in a lot of ways. It kept me along. It kept me, can I explain this simply? What was I actually thinking? But also the feedback from the students and just keeping a fresh eye and speaking with younger people. And obviously, as the years, several decades of doing that, kids keep getting younger and younger, and I keep getting older and older. The spread keeps growing. And so I just smiled throughout that incredible memo that you wrote. Was so dead on. I just couldn't help but smile. And I thank you for writing and putting into words better, as usual, than anybody else, many of the things I've been feeling and experiencing myself. So I appreciate that. And sharing that with everyone was really a great contribution. And I appreciate that, Howard.
Mm-hmm. Well, you'll be glad to know that memo, I've just started my 4th decade of writing the memos, and that memo had more response than any other in history. So you're not alone. It reminds me of, there was a book called The Money Game. I don't know if you read that. It was probably printed before
1968, yeah.
And see, that's what I mean. And in the brokerage office, the oldest guy was a curmudgeon in the back called the Great Winthrop. And all these, the 60s were really the birth of the tech and growth company. And through the marvels of progress in technology and in marketing concepts, that's really where the Nifty 50 arose. IBM, Xerox, Kodak, Polaroid, Merck, Lilly, Avon, PerkinElmer, Texas Instruments, et cetera. And yet the oldest guy in the brokerage firm was doing the best. And so the author went to him and he said, how can you be doing the best? He says, come in the back with me. He says, these are my boys. This is Huey and Dewey and Louie. And if you got to get yourself a young man. These are my kids. But I really think that it's hard. I think that our brains, as we get older, don't keep up with the rate of change in the world. And the world, when I was a young man, a kid, or even a young man in the profession, the world seemed like an unchanging place. The world seemed pretty much the same from year to year. Comic books always cost a dime, and not much changed. And of course, today everything changes every minute. It's not the same place. It's different this time. Now, that doesn't mean the past is irrelevant, because we will still assets, no matter how good they are, will still be pushed to prices which are excessive, from which you lose money, or from which they're not good investments. These are the things that never change, but an awful lot it has changed. I think that, and the other thing is that over time, dogmas harden, I think. So, one of the reasons that the conversations with Andrew pushed me to write that memo is because I think that over time, the definition of value investing hardened and, became more like a religious dogma. And, the simple emphasis on low PE ratios and the lack of reliance, the insistence on not relying on future projections and not relying on that which can't be quantified. The real question in the memo was, does that serve a purpose? And I think not. If you do purely quantitative investment based on currently available quantitative data, everybody has that data. And you would have to consistently bring some extremely unique insight in order to outperform everybody else on the basis of publicly available quantitative data. You have to get to know a few situations better than the rest and have an in-depth understanding of their fundamentals in order to outperform. It's not easy, but I think it's become harder because the world is a smarter place. Back when I started, there was no such thing as a personal computer. There was no such thing as a database or that was accessible and readable and spreadsheetable. And today everybody has everything. So there's no ignorance about the present hard data. The ignorance is about the future, and people with superior insight into the future, I think, will be successful. Why not admit that under the canon of value investing?
Right. Well, Howard, I couldn't agree more. My definition of value investing is a little different than the categories that are made by Morningstar and Russell. So, with a focus of low price book, low price sales, whatever it might be for value investing and sort of growth without looking at price is, a growth category. Obviously, there's no investing without price. And I always use the example as if I came to you with an investment strategy that says, I'm going to go buy apartments with nice views of Central Park. That's my investment strategy. That's not an investment strategy. I didn't tell you what I'm going to pay for those apartments. So there's always a price associated with them. Also, something struck a chord as you're talking, like, one of the big mistakes I made was, looking at Walmart, seeing what a good business it was, 30 years ago. And, think about it this way. If you're looking at the numbers to do with 50 stores, but you can see they can have 1,000 or 2,000 stores. It's like any of these new businesses that, sort of have an unlimited growth trajectory, the internet businesses. The numbers that you're using at 50 stores aren't very helpful. It might say, hey, I have a model here that could expand, but putting a multiple on whatever you're earning on 50 stores, obviously, if you can have 1,000 or 2,000, just to put it in terms that I can understand and comprehend and then apply to what's going on now, of course they're meaningless. Of course they're meaningless. Any multiple on those earnings or cash flows at that level don't mean anything. You really have to make some estimates about what the opportunity set is, what the competition will be over a long period of time. And of course, you always had to do that. But there are some of these internet businesses have much more unlimited runway or larger runway than are traditionally bricks and mortar businesses that, you have to build factories and everything. So that's just an interesting aspect of how to look at things, and have been traditionally even been some of my biggest mistakes in the sense of errors of commission, where just missing huge opportunities. On the other hand, it's important to stay in your circle of competence, as Buffett would say. And there's lots of ways to make money, and you're not going to have insights on thousands of things. So just getting back to value investing, I think of it as correlation and causation. So correlation might be is traditionally low price book, low price sales, momentum has worked. If those things didn't work over the next 2 years, it could be that they're just cyclically out of favor. And if you look at the very long term, they work. Or it could be that they're now crowded trades and they're now degraded. And that's why they don't work over the next 2 years. And 2 years from now, there will be no way that I could give you the answer to what's happened. Has this just cyclically out of favor, this style, or is that degraded? But our definition of value is, looking at cash flows and future cash flows and growth rates and things of that nature, actually how you'd value any asset, right? Even the money losers, you have to assume they're going to make money at some point. Okay. You can maybe measure how much cash flow they're going to make, when they're in growth phase versus not growth phase, but you can normalize that. What they spend on growth, what they spend on, normalized earnings, and you can put a value on that. And so valuing businesses, valuing earning assets, those are things that have to be part of investing, and then paying less than what you think they're worth. That's value investing. That will never go out of style. It might get harder. It may not be rote. It may not be mechanical. Even if mechanical things have correlated with good returns in the past, I think if we just bring it down to its core, that you're valuing ownership share of a business when you're thinking about stocks, and you're good at that, and you have an edge on that, and you do see an opportunity to buy them at a discount, and you're good on average at that, that's what value investing is to me. So I think if I define value investing in a broad sense that way, I'm not worried about value investing going away. I think that's just called investing, as Buffett would say.
I think that's great, Joel. I think that the important message is, for people who haven't set their course yet, or who are able to modify their course, is what you said. There are a lot of ways to make money. Growth investors, value investors, momentum investors, traders. Of course, you and I think that fundamental investing and buying things for less than they're worth is the most dependable of those. But there are lots of people who've gotten rich doing things I don't think can be done well. There are the exceptions that prove the rule. Techniques go in and out of style. And sometimes if they work too well for too long, then they stop working merely because they work too well for too long. Their end is self-creating. But Barton Biggs published a book in the first decade of this century called Hedgehogging. And he had a section where he talked about a few of the most famous investors and how much time they spent in the doghouse. So we all have to accept the fact that no approach works all the time. And certainly no approach is the best all the time. It rotates. And we should come to a conclusion about what's a good way to invest, and we should hold to it strongly. Accept the fact that it will be out of style and underperform from time to time, but we have to acknowledge that having a philosophy and sticking to it firmly is much better than having no philosophy and dabbling in each one when you guess it's going to work. I always say that if you stand at a bus stop long enough, you'll get a bus. But if you run from bus stop to bus stop, you may never get a bus. And I think that's an important thing for people to accept. Nothing will work all the time.
Yeah, one thing I'll add to that, and I've thought about this a lot. Over the last 5 years, I don't know what the number is for the stock market. The S&P, for instance, I think it's about 15% a year. Very good return. Obviously, lower, maybe 10% for Morningstar's definition of value, and much higher for growth. But the S&P in general was 15%. So if you were categorized as a value investor and you earned 12% a year during those 5 years, comfortably beating whatever risk-free rate you want to use, looking in your pile of circle of competence for investments that would comfortably beat the risk-free rate. It's not clear to me that you're a bad investor. And if I told you, hey, I think I can find a pile of things in the same line that I found in the last 5 years that earn 12%, that over the next 5 years, based on my valuation work, will earn 12%. I don't know what investing in faster growing things will do, or different categories of stocks, or you're very good at biotech or tech or whatever, and what that would earn, or whether it's better, it's worse, or whether just owning an index will work. But if I actually know what I'm doing and can comfortably beat the risk-free rate based on something I know, it's very unclear to me that we look at these things the right way. And so if I could comfortably say, look, looking at the opportunities I have in front of me based on my circle of competence, I think I can comfortably earn 12% a year over the next 5 years, you'd probably take that, even if the S&P we're going to earn 15, and even even if growth investing would do better. As you said, there's a lot of ways to make money. It's almost like comparing distress investing. If you're buying distressed bonds and you banged out a 12% return or 13% return over a period of 3 or 4 years doing that, and then you would say someone's very silly to compare that to a 15% S&P return. They're different things. There's different ways to make money. They have different risk rewards. It's a different circle of competence. It's a different certainty because there's an event. It's really event-driven investing. So in some sense, it really depends how you categorize these styles and ways about making money. And so I think it does a great detriment to because it's so easy to have all these numbers and benchmark everything to something. It's unclear whether those benchmarks are meaningful. And so that's why I like to think of more as, can I meaningfully beat the risk-free rate in a risk-adjusted way that will get me a good return? And that's the way I think about investing. And I try to do it with blinders on, is the only thing I'll say to whatever else is going on. This is what I know. This is what I think will be a good rate of return. And I think it cuts out a lot of the noise. I'm valuing things, I'm buying them at a good rate of return, and that's what investing is. And that's how I think about it.
Well, I like the idea of the blinders. One of the worst tendencies of humans is to compare. And, you give somebody a raise at the end of the year, you say, "Are you happy with that raise?" They say, "Well, I got to find out what the others got." But certainly you should set your own course. And if you achieve the goals that you set for yourself, that's good enough. And the fact that somebody else made more is important. And along those lines, I think we should close this discussion by talking about the one or two greatest lessons that we've learned. Your career now spans 40 years. Mine is 50. We should have learned something. What do you have to show for it, Joel?
Well, I wish I thought about that more. What I show about it. Well, I think the great part about investing and what I really enjoy about it is it's always interesting. It's always changing. You always have to figure things out. You always have to adapt. There are certain principles, though, that are stay the same. And if you need a good grounding, you can't just jump from what's popular now or what everyone's doing. You have to have a home base. You have to have a simple core. And I think my simple core is really in two different areas. One is there's no investing without valuation. You can't intelligently invest unless you have a good idea of what something's worth. You can't just that's why momentum investing doesn't make any sense to me. If someone said to you, "Hey, I'm going to buy the houses that were up the most last year," you would sort of say they were silly. Some reason for the stock market, people don't probably say that's silly. I don't care if it's worked or not worked. It doesn't feel comfortable to me. I think investing has to do with valuing businesses and paying less. The other part of that has to go with it is actually knowing your circle of competence. Meaning, invest in things that you understand. In class, I always ask this question. I said, what do you do with a business that is in a tech-heavy business where there's a lot of competitors, where the technology is always changing, and we're not exactly sure where we're going to be in 2 or 3 years. How do you analyze that one? Business. And I say skip that one and find one you can figure out, because otherwise, what are you doing? You're guessing. And there's nothing wrong with guessing, but then make conservative guesses. And if you still want to buy it, that's another way to go about value. So you still have a basis for valuation, and that's a home base. And understanding where your circle of competence is. It goes back to Ben Graham and Warren Buffett again. Figure out what it's worth, pay less, having a circle of competence. And what I said before, I really like to have blinders on. I can't just, when I first went on Wall Street, and I'm sure, Howard, I think I've read, you've had other stories where you got paid even less than I did because you started, I made, I think it was $20,000 or $22,000 my first year, and that was with an MBA. I took a hit to go with a startup. So I happened to have a classmate who was trading commodities at the time, who had just made $2 million trading, I think it was silver. And I signed up for a job for $20,000 or $22,000. And I learned at very early ages, if I'm going to think about that guy who I just went to school with, who just made $2 million as soon as he got out, and I'm sitting there with $22,000, not going to have a very happy life. What I want to do is find something that I really enjoy doing, figuring out the puzzle. And one thing I will say is noticing who is successful in my classes over the years and people that I've just interviewed, obviously you get overpaid in this business if you're pretty good at it, but the people who are really successful at it do it for love, do it for the fascination, do it for the challenge. And those are the people who are most successful. They, as Warren Buffett would say, tap dance to work every day. And that's really the secret. And if it's not that for you, I would just say, keep looking. If you have that luxury, keep looking for something where you just enjoy the challenge, you enjoy contributing in some way, and so that's a little secret that I would tell anyone who's young thinking about this business. So Howard, tell me your secrets of 50 years.
Well, your lessons are great, and when you talk about your circle of competence, I was in a conversation with Charlie Munger a couple of weeks ago, and we were talking about one stock. He says, well, I put that one on the too hard pile, and we all should be aware of our limitations. I was fortunate, I guess, to start work in '69, and the banks in those days bought the Nifty 50 stocks, the 50 best and fastest growing companies in America, to which nothing bad could happen and which could never be priced high enough or too high. And if you bought those stocks the day I got there in '69 and you held them firmly for 5 years, you lost almost all your money. And that was a very painful lesson. As I described in the latest memo, it really cost me my job as director of research at Citibank. But I had an understanding boss who didn't fire me, and he asked me to start up portfolios in convertible bonds and high yield bonds, kind of the backwater of the investment world. So that led to two important conclusions. Number one, it's not what you buy, it's what you pay for it. So as you said, there is no such thing as investing without valuation. It's all a matter of price. And buying, investing is a matter of buying things well, not buying good things. And you have to understand the difference. And you have to understand, as you say, it's not the best asset. It's not the asset that's been going up the most. It's the best value, the best proposition. We all know each year who we think is going to win the Super Bowl, but we don't bet on the favorite. We bet on the underdog if the proposition is good enough. And I'll just complement that with the fact that the inauguration, the onset of the high yield bond era in 1977-78, which is, I was very fortunate to be part of the beginnings, what it really said was risk return proposition. That's the key. Before that, investing mostly consisted of people who were trying to buy good assets, whether it be the Nifty 50 or gilt edge bonds or something like that. A respectable investor was somebody who bought high quality assets. The person who bought poor assets cheaply was considered a speculator. What the high yield bond era ushered in was the risk return concept, that a low quality asset can be a great investment if it's bought at a sufficiently low price. High yield bonds clearly had risks that high grade bonds didn't have, but the incremental compensation for taking those risks was much more than sufficient. That made it a compelling investment. Not only did they gain acceptability, but they were really compelling. And I think that changed the world, because now we think of everything in terms of risk return, whereas it used to be just a veneration of high quality. So the point is, the world emerged, the world evolves. You mentioned the fact that you have to evolve your approach. And I think that the pandemic and being cooped up with Andrew for all these months what it taught me is that I have to keep evolving my approach. And the solutions of yesterday are not the solutions of tomorrow. There are certain fundamental tenets we must adhere to, like you say, valuation, estimating the future conservatively, buying it for less, margin of safety, et cetera. But the mechanisms through which we implement those tenets have to change all the time as the world changes. And let's hope that you and I can keep doing that. It's really been a great conversation. I enjoyed engaging in it with you as always, and I look forward to the next time.
Well, Howard, me too. I just, before we go, I wanted to tout, I wrote a book called Common Sense, which really took what I learned in the investment world and tried to apply some of those things to some of our biggest problems. And I'm hopeful what I've learned over time about investing and how to think about that can be used in other areas. And so that's what I tried to approach in that book.
Well, and Joel, don't forget that you sent me a draft to read, and when I finished it, I wrote you back. I said, "Can I give you a quote for the back?" It's a great book, and it has two of the virtues that all your books have. It's very wise and it's very short. I recommend it to everyone.
Thanks, Howard. It's much easier to write a short book. That's something I learned also over the years. I forgot to mention that.
Thank you.
Thank you, Howard.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.